Despite the economic turmoil in 2023, the stock market is not always a reflection of the current state of the economy. While high inflation and raised rates by the Federal Reserve may cause some investors to panic, many of the world's best investors see it as an opportunity to buy into the market. Warren Buffett, known as the Oracle of Omaha, is a prime example of this investing strategy. In 2022, he invested a large sum of money in the market after staying on the sidelines in recent years, despite facing criticism for doing so. This investing strategy of investing during weak economic periods has been successful in the past. For instance, investors buying during the 2008 and 2001 crashes saw impressive returns. So, what's the secret to investing during a recession? Monish Babri, a Warren Buffett disciple and friend of Charlie Munger, recently explained the 3 fundamental rules for finding great stocks during a recession. The first rule is to look for companies with a durable competitive advantage. Being the first to market may work for a while, but it is not sustainable in the long run. Competitors will eventually catch up, and the company's edge will disappear. Therefore, it is necessary to look for intrinsic characteristics of a business that permanently sets it apart from its competitors, something that another company cannot replicate. This is what is referred to as a moat. One of the most potent types of moats is the brand moat, which is impossible to replicate. In tough economic times, businesses with strong brand moats are the best to own as people come back to their product or service and won't switch to alternatives. An example of a company with a brand moat is Coca-Cola. Its founder, pharmacist John Pemberton, could not have imagined that Coca-Cola would become the brand it is today. There is nothing particularly magical about Coca-Cola, and the formula can be easily replicated, as several companies have done. However, Coca-Cola's brand is what sets it apart from its competitors, and it is one of the best companies to own during tough economic times. The brand moat is the most powerful type of moat, and companies with very desirable stickers have the strongest moats. Another example of a company with a brand moat is Ferrari. Despite there being cheaper cars out there, Ferrari's demand never drops because of its brand moat. People do not buy Louis Vuitton products because they are of high quality. Instead, they are made of the same stuff as other products. People buy Louis Vuitton products for the brand. In tough economic times, people will still buy Ferrari and Louis Vuitton products because they want the brand. The second rule is to look for companies with high-quality financials. Companies with low debt, high free cash flow, and a high return on equity are the best companies to own during tough economic times. These companies will be the first to rebound when the economy picks up. In addition, companies that have a consistent track record of paying dividends during difficult times can also be great investments. This is because dividends provide investors with a stream of income, even when the market is down. The third rule is to buy when the market is irrational. When the market is panicking, investors tend to sell, which causes the stock price to drop. However, if the company has a strong competitive advantage and high-quality financials, it is best to buy when the market is irrational. This is because market downturns are often temporary, and the market tends to recover eventually. However, it is important to note that investing during a recession requires patience and a long-term perspective. It can take several years for the market to recover fully, so investors must be prepared to wait it out. Moreover, investing in individual stocks can be risky. The strategy of investing during economic downturns is not without its risks. For one, it requires patience and a long-term outlook. Investors must be willing to weather the storm and hold on to their investments for a while, even if they don't see immediate returns. Additionally, not all companies with moats and high-quality financials will perform well during recessions. The market can be unpredictable, and unforeseen events can impact even the strongest of companies. As such, investors must conduct thorough research and analysis before making investment decisions. Moreover, it's worth noting that the economic environment in which investors operate can vary greatly. While the 3 rules for finding great stocks during recessions may hold true in certain contexts, they may not be as effective in others. For example, during the COVID-19 pandemic, the market experienced a downturn that was unique in its scale and duration. The pandemic's impact was widespread, affecting businesses in all sectors, and the market reacted accordingly. While some companies with moats and strong financials performed well during this time, others struggled, and some industries were hit particularly hard. Despite these challenges, many investors remain confident in the long-term prospects of the market. They see economic downturns as opportunities to buy high-quality companies at a discount, and they believe that over time, the market will recover and continue to grow. As such, they remain committed to their investment strategies and continue to search for great stocks even during tough economic times. In conclusion, the strategy of investing during economic downturns has proven successful for many investors in the past. By looking for companies with durable competitive advantages, high-quality financials, and buying when the market is irrational, investors can position themselves for long-term success. While this strategy is not without risks, it offers the potential for significant rewards for those who are patient and diligent in their investment decisions. As the world continues to navigate economic uncertainties, it's likely that this strategy will remain relevant for investors looking to build wealth over the long term.